Hi everyone, I'm Bagadan at StockMarketCaddy.com, and I just want to take a moment and explore further the subject of a market order versus a limit order. We go into detail in Logan's 5 Easy Lessons. We mention the difference. We also do so in the Jumpstart series. But there are some other nuances depending upon how advanced your platform is, and I just want to bring that to your attention. This is by no means explaining every possible location where one can place a market order or a limit order or even structure it. At TradeStation, there are fortunately a number of places to place orders, and it's up to each player to research and to practice and to learn the different tools that work best for them. But in general, and we're going to draw a house as an example. So bear with me with this little drawing. If we had a house and the house was for sale, and let's say the sellers were asking $300,000 for the house, the sellers would be on one side of the page. And there may be more houses for sale, and we'll just as we go up, they could go from 310. That will go, let's say, if we were trading futures, they'd be in tick size, whatever that tick size is it go from 300 to 310, 320, 330, 340, for instance. And as they stack up, that's also what we refer to as the depth. If there are other sellers at these higher levels, we would say that the market is deep, okay, whatever that tick size is. So, but they're asking this price. They're asking. On the other side of the equation, over here, we have the buyers or the bidders where they're making offers. And in this case, this gentleman's offering 250K. And the same thing, there may be buyers stacked up over here. If there are big gaps, we could say that the market is not very deep. So these guys are asking, these guys here, these dudes, they're bidding. These are the buyers, these are the sellers. The difference between the price here of 300, or what he's asking, and the buyer is known in what we call the spread. And in this example, the spread is quite large. The spread is 50K. That's a large spread. For a futures contract, now when a market is deep, the spread can vary, but in a deep market, the spread will be very, very narrow. When trading in futures, it could be the difference of just one or two ticks. In a thinly traded market, the spread could be quite wide and sparse, especially in an evening. And it could be that market may change during the course of the day when it is deep or thin. So when you place an order, let's say a market order, what you're saying is if you are the buyer and you say, I want to buy and I want to do so with a market order, you are saying to the sellers, I'll basically take anything. Usually it will be maybe the best price offered. But if your order comes through as a market order and this guy sees it and he says, I cancel that and I'll sell it to you at 320, he changes that. He can cancel orders. Then guess what? You don't get 300. You get the house at 320. The difference between that 300 and 320, that 20K, and we're doing this as extremes, could represent slippage. You get kind of sloppy with your entry. Now, if you are chasing markets, chasing here, chasing there, you may not have any other difference. If prices are rapidly rising and you want that order, then a market order is going to get you in really quick, and it's not going to give you maybe the best price. However, if you're ordering and the market is orderly and you're not chasing, you can put in what we call a limit order. And in a limit order, you get exactly what you ask. So you might say, you know what, he's not taking this, I'll put in 275, but that's it. That's all I'm going to risk. This would now be 25 spread. And you let the order sit there, and then he gets impatient and he says, instead of doing that, he says, okay, boom, I'll take it. And you get the house at 275. Basically, that's the very simple difference between a market order and a limit order. But with a lot of the platforms, unfortunately at TradeStation, you have a lot more flexibility and functionality than you might realize. And there's a place to use all of these different orders at various times. It's your responsibility, whatever platform you're using, to get familiar with the tools, practice in Sim, understand what the subtleties are, and to see if it can help your trading. I think if you're an active trader, it's not I think, I know. If you are an active trader and you are routinely putting in market orders, then you could be spending hundreds or wasting hundreds, if not thousands of dollars each month. You want to try, one, not to chase markets, but to get the price, to get the best price, both on the way in and on the way out. If the market is moving against you quickly, or even with you quickly, and you want to rush that order, that's fine. But as a routine, it's probably not a good idea. In this example, this is a tool, a very basic tool from TradeStation. It's trading the ECZ, which is the euro. Here are your sellers, the ask. Here are the bidders, the buyers on a futures contract. The spread is very, very narrow, one tick. If you want to buy at that price, you can put in a buy limit. If you want to rush an order, you want to get a buy, you could say a buy market, but you might get this price or you might get that price. It depends. You don't have that type of control when you put in that buy market. If you want to sell, you can be putting in a sell limit, or you can put in what they call a sell stop and a mark. And what happens is, as soon as it hits that price, ordinarily you would get that order. But if it doesn't, it will put you into a market order. It's a very beautiful tool to use. The tutorial is about over an hour. Very important to watch it and to understand what it is showing you. Now, we're not going to overstep those tutorials on TradeStation because they are very, very good in their own right. But this is where the sellers and the bidders come to market, and very graphically shown. There is another tool at TradeStation, the little trade button. Here you can put in a buy limit or a sell limit. You can put in a buy market or a sell market. You can take an order, buying an order at the bid, or you can hit or sell an order at the bid. You can split the spread. You can bid within one tick of the other best bid, or ask within one tick of the best ask. A very powerful little tool. What it's trying to do is give you the flexibility to get the best price going in and going out. So you can have the best strategies in the world, you can have the best tools in the world, but if you don't understand how to place your orders, or you're lazy with them and you haven't practiced, over the long haul, you're going to pay dearly. Now, there are other places to place orders. We like to place orders right from the screen, and that is a beautiful way to get the best price. Also on TradeStation, underneath strategies and under properties for all and automation, you have the capacity to set your orders as limit orders, and if they're not filled within so many seconds, they will turn into market orders. And once again, very powerful tool. I'm Bag of Don at Stock Market Caddy. I hope you enjoyed this little 11-minute YouTube video. We're going to post this for everybody, and then it is going to go into our website just for our own members. But tonight we'll post it for everybody. We wish you the best in your trading. And as the markets gap tonight, it's very important that you understand what can happen in a market. Even if you're not a futures trader and you're trading ETFs, there have been instances where ETFs, you have the capacity to set stops, but during times of large market stress and in thin markets on thin ETFs, there is the potential to, if you have a stop loss in, for that stop loss to turn into a market order and lose much more than you think possible. So it's something you want to think through, something you might want to discuss with your broker, your financial planner, if you are putting in stop losses or stop orders on ETFs or other products. It does not necessarily guarantee you that you're going to get that price. And even a stop limit, carries its own risk, because if you don't get that price, you don't get that price. And if you haven't instructed the market to turn it into a market order, and the market continues to go down or against your position, you could lose much more than you realize. So when it comes to placing market orders, limit orders, stops, you really want to understand what the difference is, how they are used, and whatever platform you're using, make sure you watch their tutorials, you practice with them, and you understand what you're doing. It would be a shame to have used a great strategy and to have executed what could have been a great trade, and for the lack of understanding, place a market order where it should have been a limit order, or what have you, and pay dearly for it. Okay, so we wish everybody the best. I'm Bag of Don at StockMarketCaddy.com. Good luck.